Welcome to Part 2 of 2 for business owners who wish to learn more about the Affordable Care Act. If you haven't already viewed Part 1, we suggest that you do so, as Part 2 is a continuation. Individuals may also find these presentations of interest. These presentations will give you a good understanding as to why your employer is providing you with certain health care notices and why your employer is taking certain steps with respect to the health care coverage. Listen and enjoy. The law anticipated the creativity of planners who would contemplate restructuring companies to gain the benefits of the grandfathered provisions. Here are some examples of strategies that will not work. As an aside, if the law imposes anti-abuse rules to prevent employers from claiming grandfather status to avoid the new law, what does that say about the new law? As indicated on this slide, the Health Care Act does not require group or individual plans to cover all conditions. Again, employers must work with their health care service provider when making any changes to their health care plans. The first bullet is important because if an individual has a pre-existing condition and wants it covered by his health plan, he needs to find a plan that includes coverage for that condition. If he chooses a plan without coverage for that condition, there is no pre-existing coverage. Notice the difference between group plans that are not exempt from the pre-existing condition prohibition and individual plans that can be exempt. This incontestable provision eliminates subscribers being denied coverage during the prohibitionary period of the policy, except for fraud or intentional misrepresentations of material facts. Of these 4 bullets, the first bullet is of the most interest. With employers looking for ways to decrease health care costs, will they opt not to include coverage for spouses? This slide was included to alert employers with self-insured plans or health reimbursement account plans that they are now required to file Form 720, an excise tax return. Employers must know if they are a small employer, a large employer, or neither. A small employer is defined as having less than 25 full-time equivalent employees. It is important to note that a full-time employee is not the same as a full-time equivalent employee. A large employer is defined as having 50 or more full-time equivalent employees. Employers between 25 and 49 full-time equivalent employees are not subject to the new rules. All employers, regardless of the number of full-time equivalent employees, are subject to new W-2 requirements showing the health care costs provided by the employers to the employees. This is a capsule summary of the small employer tax changes. The new law allows employers to claim an income tax credit for health insurance premiums paid. As with much of the tax code, there is a complex formula to compute the tax credit. The tax credit is reduced when the average salary exceeds $25,000 and is totally eliminated when your employees, on the average, make more than $50,000 in compensation. The credit is also determined by the number of employees. If the employer had less than 10 full-time equivalent employees, the credit is reduced. If you operate as an S corporation or a partnership, the tax credit, if any, will be computed at the business level and then reported on the K-1 issued to the business owner to claim the tax credit on their personal income tax returns. This slide should give you an idea as to how the number of full-time equivalent employees is computed, as well as the average annual salary per employee. The employer computes the total hours worked by all employees. If any employee works more than 2,080 hours during the year, those extra hours are ignored. The total hours worked are then divided by 2,080 to arrive at the number of full-time equivalent employees. Fractional numbers are rounded down to the nearest whole number. The employer then takes the total wages paid to all employees during the calendar year and divides that amount by the previous computation of full-time equivalent employees to arrive at the average annual salary. This computation is rounded down to the nearest 1,000 to arrive at the average annual salary. However, the tax credit is reduced if the employer-paid share of the healthcare premiums exceed the average premium for the small group market in the state where the employee works. While this test makes the computation more difficult, it will be especially more difficult for those employers who have employees in more than one state. The second bullet on this slide illustrates how the income tax credit will be computed when the state market results in a lesser premium. This slide illustrates the computation of the number of full-time equivalent employees and the average salary paid. Adding up the total number of hours worked for all employees, ensuring that the cap of the number of hours worked does not exceed 2,080 hours, results in 8,060 hours worked. Dividing the 8060 hours by the 2080 results in a figure of 3.88, which when rounded down to the lower whole number results in 3 full-time equivalent employees. Whereas one would think that the average salary paid was $30,968, the tax credit formula requires that the $120,000 be divided by 3 full-time equivalent employees, resulting in an average salary of $40,000. As this example illustrates, the formula is designed to increase the average annual salary, and the higher the average annual salary, the smaller the tax credit. We included this slide to illustrate how the tax credit is affected by the state premium limit. Although the employer paid $12,000 in total employer premiums, the credit is not equal to 35% of the $12,000 or $4,200 because of the state premium limit test. Since the state premium is less for each employee, those premiums are used in the computation. You will notice that the employer paid either 1/2 or 1/5 of the total actual premium costs. Thus, the employer is limited to half of the state premium dollars for Adam and Kathy and 1/5 of the state premium dollars for Bob and Denise. This computational step reduces the total premiums for the tax credit from $12,000 to $10,743, resulting in a possible tax credit of $3,760. This slide summarizes the computation of the tax credit. The Act requires large employers, those employers with 50 or more full-time equivalent employees, to offer health insurance, but not to pay for it. Before large employers think they do not have to pay for health care coverage that they offer, the employer must check the state law requirements, which may require that the employer pay a percentage of the total premiums for its covered employees. If the employer does not offer health care coverage, and at least one employee is certified as enrolling in a health care plan through a state exchange program, or receive a tax credit from the IRS, the employer is penalized. The penalty is equal to the number of full-time equivalent employees greater than 30 times 1/12 of $2,000 for each month that the employer does not provide coverage. In the above example, the employer's penalty would be $6,667 per month until the coverage is provided by the employer. There has been much publicity about large employers reducing employee hours to less than 30 hours to avoid having these employees counted as full-time equivalent employees. Reducing the number of full-time equivalent employees reduces the dollar amount of the penalty. Here is an example of when large employers offer health care coverage, but at least one employee receives a premium tax credit or a cost-sharing reduction through a state exchange program. This illustrates that employers who offer healthcare coverage may be subject to a penalty. The penalty is equal to the number of full-time equivalent employees receiving such a credit times 1/12 of $3,000 or $250 penalty per full-time equivalent employee per month. Shown above is an example of the cap that is placed on the penalty provision. When employers are offering their employees great healthcare coverage, the Act imposes additional tax on these Cadillac plans. When employers offer their employees great healthcare coverage, the Act imposes an additional tax on these Cadillac plans. For companies that self-insure, they would pay this excise tax. If these plans are obtained from a healthcare provider, the healthcare provider would pay the excise tax. Since an insurance company is not going to pay the excise tax and decrease its profits, the cost of these plans would need to be passed on to the employers, making the employer's healthcare premiums increase. Many unions who have forego wage increases to obtain better healthcare packages are complaining that they should be exempt from this excise tax, as it would make their plans unaffordable. While this provision of the law causes employers to drop these plans to better control the healthcare costs. If employers see that the competition is reducing its costs, which enables the competition to have a pricing advantage, employers will react to their market conditions to remain competitive and not to lose market share. If large employers can keep their full-time equivalent employees below 50, they can avoid penalties imposed on large employers. Another employer tactic that is being used is to reduce employee hours below 30 hours per week. This means that today's employee benefits associated with full-time employment, in addition to healthcare benefits, may be lost. If you have any questions after viewing this presentation, please email them to the email address shown above. Be sure to include your full name and complete mailing address and telephone number to reach you during normal business hours.